value the security with the law of one price. Again, let's assume we have a security has a risk-free payment of $1,000. The interest rate risk is 5%. What should that price be? And again, we can go back to our time value component here, and we can plug in here and say, look, we got something for $1,000. It's the $1,000. The risk-free rate's 5%. That asset should have a price of $952.38. That is the price that we would expect to pay for that. Well, what if you could buy this for a different price? Well, what if the price was different? That will have certainly will make you change whether or not you want to buy or sell the asset. So let's look at this example. What if the price of the bond wasn't $952, but what if it was $940? You could buy the bond today for $940, and in 1 year you would get $1,000 for that. Or you could borrow money from the bank for $952.38, and at the risk-free rate of 5%, a year from now that would be worth $1,000, and you could pay it back. So in 1 year you have nothing. The transaction nets out to zero, but today you have a positive cash flow of $12.38. So what should you do? You should do this as much as possible, because every time this transaction happens, you make $12.38. So what's that going to do? It's going to say more people are going to be buying the bonds and more people are going to be borrowing. So what happens when more people are buying the bond? It's going to drive the price upwards. What's going to happen to a lot of people borrowing from the bank? Should reduce the interest rates, which ultimately should have some impact on the value, the amount of money that could ultimately be borrowed. But if we just think about buying the bond, the more bonds people buy, the price is going to go up. Eventually, the price will be exactly equal to $952.38. So unless the price of a security equals the present value of the security's cash flows, an arbitrage opportunity is going to appear. So in a no-arbitrage world, the price of the security is exactly equal to the present value of all cash flows paid by the security. What process do we need to go through? First of all, we need to obviously identify all the cash flows. We also need to determine what is the cost of replicating these cash flows on your own. We have to have two things ultimately to compare to. We need to have two assets, again, the law of one price. We have to create a system of cash flows where there are two things that are identical in nature. If they are identical in nature, they should ultimately have the same price. So let's consider this. We have a security that pays its owner $2,000 today and $3,000 in 1 year without any risk. Again, suppose that the risk-free rate is 6%. What is the no-arbitrage price of the security today? Again, if that security is trading for, let's say, $4,750, what arbitrage opportunity is available? So let's look at that. Let's look at that question. Let's think about that. You pay $2,000 today, and then $3,000 in the future. So you have two positive cash flows, $5,000, and the risk-free rate is 6%. So what should you be willing to pay for that? Should you be willing to pay more than $5,000 for that? Will it be less than $5,000? Again, without going through all these, the concept here is we have to be able to show the relationship between these cash flow streams and how it ultimately works together. So let's go just to another example. We have this risk-free bond that pays $1,000 in 1 year. It's currently trading for $929.80. The bond's price must equal the present value of the bond that's going to pay $1,000 in 2 years. So what is the risk-free rate of return on this particular kind of investment? And again, going to the time value spreadsheet, you can see here that we have what? It costs $929.80. You're going to get $1,000 in a year. All right, it's a 1-year investment. And the interest rate that this is going to pay is 7.55%. So if we say that this is a risk-free bond, we imply that, then this interest rate must be the rate of return for a risk-free asset. So again, let's kind of bring these concepts together. In a normal market, the net present value of buying and selling the security ultimately is 0. The net present value of buying a security is the present value of all the cash flows paid by the security minus the price of the security. And again, that ultimately equals 0 in a normal competitive market. Likewise, in a selling transaction. So trading securities in a normal market neither destroys or builds value. I think this is sometimes a little bit of a confusion in the marketplace where you think, well, all this activity is happening in the stock market. What's happening to the assets of these companies? Are they changing? What's going on? And exactly what we're talking about here is that the value of a project, the value of a company, is the real investment of that company in projects. We have to ultimately determine what the price is of that value. That's what the stock market brings to us. We have talked about this separation principle a little bit earlier. Again, we can look at net present value separately from the decision of how it finances it. That is the definition of the separation principle. So let's see how that might work. Your company is considering a project that's going to require an upfront investment of $10 million. It's going to produce $12 million in 1 year with no risk. Rather than paying for the $10 million, the company is going to decide to raise some additional funds by issuing a security that's going to pay investors $5.5 million in 1 year. Again, suppose the risk-free rate for that asset is 10%. Is pursuing this project a good decision given the concept here? Does it make sense to issue this security? Well, let's work our way through here. Without the new security, the cost of the project's 10, the benefit's 12 million. Converting that to present value at 10%, the net present value here is, the value is 10.9. So we see that the project net present value is 10.9 million minus the cost of 10. It's worth $0.91 million, which obviously says we should do this project. But now what about this security that we could do? The price of the security is 5.5 million divided by 10. So it's going to raise $5 million today. So after it raises 5 by issuing the security, it's only going to have to invest another 5 million. So to compute the project's net present value, again, we're going to get the $12 million payout for the project, but we owe $5.5 million. That leaves $6.5 million for the project, for the company. What's the amount of the present value? $6.5 million. What's the value of that today? It's $5.91 million. Thus, the project has net present value of what? $5.9 million minus the $5 million. It's still worth $0.9 million. So it didn't matter whether I borrowed money or not. It doesn't even matter how much money I borrowed. The net present value is the same. So again, this is just an example of this separation hypothesis. It says, look, the decision is made simultaneously, but they are different decisions. We figure out what assets have good value to the company based on their risk, their cash flows, etc. And then we also figure out how we're going to finance the project. But how we finance it will not have any impact on the value of the asset itself. So if you think about valuing of an entire portfolio, right? The company buys project after project after project. Value additivity says the end value of a company, price C, is the price of the assets individually added together. So we have this value additivity concept where we can just compute and bring assets together to increase the ultimate size and value of the company. We have a public trading company, only 2 assets. It has 60% of this hotcakes restaurant chain, and it has an ice hockey team. The market value of the holdings company is $160 million, and the market value of the restaurant chain is $120 million. So what is the market value of this hockey team? So how can we do that? So it has 60% in the restaurant and the hockey team. By value additivity, the sum of the stake in the hockey team has to equal $160 million, the market value of Holbrook. Because the 60% stake in the hotcakes, 60% of the $120 million in the restaurant is $72 million, then the hockey team has to have a value of $88 million. Again, the company itself is worth $160 million. So the combination of the 2 assets has to equal that. That is, again, the concept of value additivity. To maximize the value of the entire firm, we have to make decisions that maximize net present value. Net present value of the decision represents its contribution to the overall value of the company. The more things we add together, the higher value of the company should ultimately grow to. So, what are the next concepts? Where do we go from here? What about risk? I mean, we really haven't talked much about risk, right? We've been assuming a risk-free environment. Well, when cash flows are risky, we have to change the discount rate. We certainly can't discount them at the same rate of return as the risk-free rate. We have to add to that. So the risk premium that we add is going to vary dependent on the project itself and also with the economy, with the marketplace, etc. So what about risky versus risk-free cash flows? This actually comes from part of the appendix, right? So if we assume that there's an equal probability of both a weak and a strong economy, here we have the risk-free bond costs $10.58. The weak economy, it'll be worth $1,100 a year, $1,100 a year. So we know that in 1 year this risk-free thing's worth $1,100. But the stock market index could either be worth $800 or $1,400. So how do we ultimately figure this out? What's the price of the risk-free bond? Well, $1,100 in 1 year divided by the risk-free rate of 4% tells us that this bond is worth $10.58 today. And of course you can see that that's the price tag. So what's the expected cash flow though from the stock market? Well, you just take the weighted average. It's a 50% chance of 800 plus a 50% chance of 1,400 gives us $1,100 is the value of the market index. And again, if we kind of go back just one step, we can see that that the market index is currently valued at $1,000, but it has a value of $1,100. So where are we taking this? What ultimately is going to be the meaning of this? Well, we can see that the current price, the current price of the index is less than what its future value is going to be. What rate of return will that bring to our investors? Well, if you kind of look at this, it's $1,000 is the price. We know that there's some risk because it's in the stock market, and we know that the future value is $1,100. Quite simply, you can figure out that's about a 10% rate of return. So what we're saying here ultimately is there's a difference in return here. That the risky asset provides more cash flow because it is a riskier thing. It's going to give you a higher rate of return than the 4% that's in the risk-free asset. So it has ultimately then here a 10% rate of return. What about risk aversion? Risk aversion just refers to how you and I think about things. And of course we all have different thoughts. We all have different ways of looking and analyzing information. even if you have the exact same information. There's always differences in how you feel about the strength, the reliability, etc. The risk premium is the additional amount that an investor wants to compensate them for the risk that they feel that they're going to be subjected to. So again, obviously when a cash flow is risky, we have to discount that cash flow at a rate of return that's higher than the risk-free rate, but includes this appropriate risk premium. And again, that's hopefully something that we can build as we work through the course. So if we go back to this concept, right, we can get, if we got $1,400 on this, obviously we're talking about the market index, you can get $1,400 over 1,000. That means in a strong economy you'd make 40%. In the weak economy you'd actually lose 20%. So what's the expected return? And ultimately it's that return we just talked about. Half of 40% is 20 and half of negative 20 is negative 10. You add those together, we end up with a 10% rate of return on that risky asset. So what's the risk premium? The risk premium ultimately then is the increase in return. If we kind of go back, if you remember, the risk-free rate was 4%. So the risk premium on this particular asset must be 6%, the difference between the two. So again, if we have want to combine these cash flows, try to put these in a concept where we could create a portfolio that would create the same assets. Again, the market index is worth $1,000, and if the market price today of the risk-free bond was $769, and it could give us $800 under each circumstance. Security A, we don't know what that price is, but it could give us $800 or $600. So now we have this version. We say, look, a market index should give us, its value is 1,000. This is a 10% rate of return. How do we find this missing price? The price here has to equal, if the cash flows are the same as the market index, then it has to provide the exact same price. So all we need to do then is obviously subtract here, and we would find that the security A, since it helps to create the market index, and the market index has a price that we already know about, it's going to have to sell for $261. If not, then there's arbitrage opportunities. So the risk of a security is always going to be evaluated relative to other investments in the economy. The risk premium is going to be higher the more its returns tend to vary. And if the securities returns vary opposite the direction of the market index, then it's obviously going to have a negative risk premium. And in the context of finance, we would talk about that ultimately would offer us some form of insurance that would help offset some of the negative impacts when the market changes against us. So what consequences do transaction costs have? We already kind of talked about this. If it costs money to store, if it costs money to ship, that may be incorporated into the other price. So the other price could be higher, but because of transportation, storage, insurance, etc., the net impact of the price, our price, which is lower, plus those costs, ultimately is going to be very close or the same number as what that higher price is. So it's kind of a complicated discussion of the law of one price. We're going to get into now more of the techniques of how we analyze assets, and hopefully we can clear up some of the holes here with this particular concept.